Hello and welcome to the special show. I am Anuj. With me, of course, is Prashant, and we have a special guest joining us. Raamdeo Agrawal, Chairman and co-founder of Motilal Oswal Financial Services, is here right in our studio. Raamdeo, good morning. Always a pleasure, and things are back to normal. You are in our studio.
Yes.
We would have hoped that, once this pandemic was over, things were really normal, but now this war has come on us. So something is bothering the market, whether it was pandemic or whether it's the war.
Yeah.
First of all, great to have you. Your thoughts on, what we have gone through.
Yeah, so we were hoping that we'll have a wonderful 22-23. I mean, 21-20 has gone again in fighting COVID, and we'll have a wonderful peacetime 22-23. And risk, one thing I have seen that whatever you think is the risk, that is not the risk. Risk is something which is not visible. So you have to be always prepared for something. We are saying that, okay, war is over, or war would be over, or COVID is over. But something else is kind of brewing somewhere. So I think the risk has played fully, and risk assets have suffered in last 30 days or so. So I think one set of risk play out is maybe at the peak or coming to an end, and then we'll start. And I think we have to prepare for the peacetime now.
Prepare for the peacetime, portfolio-wise.
Yes.
Raamdeo, two questions. One is what everybody wants to know.
Yeah.
Is the worst somewhat visible? I mean, what we've seen in terms of the price damage we've seen. And second, we were in absolutely no doubt that this was a roaring bull market till last year. Has that uptrend been broken, or you think this is just a pullback in that uptrend? Because when you're in the midst of that pullback, it seems like, the world is completely sort of gone for a sixer. What's your sense?
So clearly, the problem is not over. And in what shape it will be over? What will be the lingering sanctions and the world order which is kind of vitiated right now? And it has its own cost. In the sense that sanctions, if they continue in whatever form, and things will settle down. Once you have created such a big kind of disturbance, it will take its own time to settle down. So the commodity prices, oil prices, gas prices, and a lot of economics of a lot of businesses have gone topsy-turvy. And consumers may not be willing to pay the pass-on cost. So I think we have to assess over the quarters which are the businesses which have done well, or which have done well and which are actually suffered and will suffer in the day. Many quarters to come. So that assessment will happen, but my sense is that we have seen the worst of it is the stock market. One is what is happening in Ukraine, USSR. Second, what is happening in stock market front, that is more than $1 billion daily selling by FI, because that is a real war for us. We have to face that every day. So I think that we have faced brilliantly. So they have had a wonderful exit from India, I would say. But I think they will have very painful entry if at all they want to enter.
Okay, yeah, and that's an important point, right? $1 billion a day, and it's being absorbed, Raamdeo, right?
3-4 days continuous.
3-4 days continuously. If it was a market of say 2007 or 8, we would have seen
it's a completely structural change. There's a complete change. I don't know who all are buying. Of course, retail is there on one side, but
retail is there, and DI is also retail, right?
They're also retail. Yeah.
Absolutely. So that is my question then, Raamdeo, and we of course don't know. We'll always be wiser with hindsight, whether it was just a fall or bigger fall or a bear market. We don't know.
Yeah.
But is this a bit of a risk for the market, because a lot of this money has not seen a bear market? A lot of first-time investors are there, and they have put a lot of money. So, do you see that emerging as a bit of a risk?
Yeah, that's a risk, because the behavior can be quite crazy. You can push them to a particular extent. After that, when they break down, everybody will break down together. But this time, the fixed income has also collapsed. So you don't have a place to hide. When you leave the equities, you end up in 5% kind of a post-tax return, which is also not acceptable to the people. In fact, one of the reasons they have come in, apart from retail, is that collapse of fixed income. So I think that fixed income is not going back to say 7%, 8%, 9%. So there is no logical transfer from equity asset class to permanently into the fixed income side. So I would say they might stay back for the time to come. But they will, whenever the market starts recovering, because they know only price, they don't know value.
Yeah,
this crowd doesn't know value. This crowd knows only price momentum. So as the prices stabilize and they start moving up, they will come with double speed, because now, boss, we've got it and we have now traded.
Just a follow-up. So you reckon this selling is more from the momentum ETF kind of funds and not the long-only funds?
That's what I get to hear, that they are emotionless while selling, and they will be emotionless while coming also.
No, you said that the exit has been wonderful, but their exit, but entry will be painful.
Very painful.
Which means you are anticipating a ferocious comeback as well for
I would
markets.
think so. But it all depends on how things shape up, in the sense that how suddenly war stops. I mean, there is this thing, what do you call, withdrawal of the troops or something like that, dramatic withdrawal of the sanctions and all. So we don't know how things will shape up. But markets are markets, in the sense that once the markets, they realize that we have got over the peak of the problem, then they will start rallying.
Just one thing, there is more and more sort of people who study this thing are starting to believe that even if the conflict on the ground stops, it's not as if commodity prices will all revert back to pre-conflict levels.
Yes.
Maybe they'll stay higher for much longer. Is that baked into in your assessment of?
Prashant, it is very tough to figure out the damage done. I'm telling you, it is, as the time comes by, we'll realize that the weaker industries have become weaker, and weaker companies in those weaker industries have become worst. Okay, and the stronger industries will emerge stronger out of this crisis again. And among those stronger industries, stronger companies will emerge even strongest. So we have to see. We can do nothing about the external environment. This is a ground given to us to manage money or invest and make money. So what happens to the corporate earnings? I think ultimately we have to figure out where the corporate earnings are going. We were thinking that it will be upwards of 875, 885, 890. Post-budget we had come to almost 890, 900 we were fiddling with. So I said 18,000 looks to be fairly priced kind of index. And now you are at 15, 16,000. So I think you have a good play if things settle down, and still earnings for 22, 23 is broadly intact.
Yeah, I mean, I use the Motilal estimate, of course, for arriving at that index number as well. But Raamdeo, just getting back to your last question, you said fixed income is not coming back anytime. But even before this Russia-Ukraine war started, market had started to fall, and one big risk factor was. Even before this, inflation was already rising, and Fed was clearly going to rise rates, and jury's still out on how much they'll raise. But before the war, it was clear that they might even raise 50 basis points. So, in that sense, how should people position their portfolio, given that the ultra low interest rates environment might be behind us?
Yeah, in fact, now it has become worse because the inflationary pressure which was there, that is further exacerbated by higher commodity prices across the board, and speculators, they are best in doing this, in the sense that what the oil price should be 110, it will go to 150 if they can squeeze you as much. So that's what is happening right now. So I mean, clearly inflation situation become worse, but how much of demand destruction is going to happen, and what kind of a post-war economy, world economy we are going to see, and what kind of world is very interdependent, whether you like it or not. I mean, the world is, the NATO allies are dependent on China and Russia, and China and Russia is also dependent on other side. So they have to accept this fact, and then at some point of time they'll realize that enough is enough. Let's get back to the taking care of the economy. So I think right now it is punishing the economy the top priority rather than taking care of the economy. So I think as the settlement happens, the whole thing will change. And so I think investing has to be bottoms up right now. To say that this sector is going to be, I mean, yes, at one level you can say, but still I think a lot depends on the strength of the companies, how they are going to negotiate this entire turmoil.
You said some companies sectors will get stronger, companies within will get even stronger, and vice versa.
Yeah.
We had a significant fall, I mean, topsy-turvy all over the place. Which are, to your mind, looking very strong out of this?
See, fundamentally, I think services will do better than manufacturing, because all this raw material is going to manufacturing. So who's hit where and how much? Who knows? So that you have to do company-wise assessment in manufacturing. If you're using too much of nickel, I don't know what is going to happen to that company's raw material cost, and can you really pass on? So overnight you are negative territory. Cement company, they are in current cost structure, they are negative territory. I mean, so how they come back, how much they are able to pass on. So those things we have to see. But at the same time, services companies like say IT, banking, insurance, all these companies are broadly not impacted. Even broking, I mean, we see that it is not impacted. So yes, mark to market, the losses to the customers, their own sentiment, that is going to hurt for sure in the short run. But broadly, the business model is not impacted.
Services over manufacturing.
Okay. Are you surprised by this near collapse of the big banking names, Raamdeo? Of course, the easy thing to say is it's FII selling. But names like HDFC Bank hitting 52-week lows, Kotak Mahindra Bank for a good period of 12 to 18 months doing nothing, underperforming the market.
I would think that they are in a very sweet spot, I'm telling you, as a business-wise. They are the 4-5 banks who are going to underwrite the entire India growth story. And the asset quality fully provided, credit cycle is on an upward swing, and credit cost cycle is on the downward swing. What more do you want? And then there is a 15-17% natural growth.
It's not reflecting in the stock price.
It is not reflecting because of this FI selling. I mean, see, they own 70-75% of all these banks. So when they have to, index-wise, they have to hit. They have to, I mean, I think close to 27-28% is banking in India. And all private sector banks they have.
Yes.
So when they sell index, that much sale comes on these companies. And once the retail also knows that here the flow is coming, he would also stay back.
Yes.
Absolutely.
Okay. And that creates big value. See, this is the time where now the guys who are thinking that it is expensive, it was expensive in the market at some point of time. Now, selective value picking must happen from the growth stocks.
Got it. Okay. Got that. Raamdeo, stay with us. What we'll do is we'll take a quick break here. We come back and we'll bring in two gentlemen from diverse sectors. Anuj Singhal of Sri Digvijay Cement for a discussion on the sector will be joining us. And of course, later we have somebody from the tech space as well joining in. So stay tuned. More conversation with Anuj Singhal, Raamdeo Agrawal on the other side. Welcome back. You're with us here on this special show. We have our guest editor today, Raamdeo Agrawal, chairman and co-founder at Motilal Oswal Financial Services. You heard him on markets, and he believes that, maybe from a market point of view, stock market point of view, a lot is already perhaps being priced in. Now, of course, we've got to wait for geopolitics to settle down, which he believes, should happen. Let's talk about specific sectors. Raamdeo, you mentioned cement as one sector which perhaps does get hit, at least in the short term. How much, of course, will depend on, what they're able to pass on in terms of price increases which they are facing. We have someone from the industry joining us, a veteran really. Anuj Singhal is executive chairman at Sri Digvijay Cements, joining in. Thanks very much, Mr. Singhal, for joining in. Prashant this side. Raamdeo is with us as well. Anuj is here as well. I just want to sort of ask you, how much of a risk is this cost push that you are seeing to earnings as you see it?
Well, if you look at it on a day-to-day basis, I think we are almost at the wiping off situation. If you were to buy coal at $300, you can't run cement. But I don't think one should look at 1 week or 1 fortnight to bring about these kind of cost increases, whether they can be passed on, they cannot be passed on. I mean, this kind of industries are for long haul. Certain amount of surprises, and last 40 years of my experience, I've seen right from 91 Gulf War. So these energy shocks are there. They come once in a while, once in 10, 15 days for a variety of reasons. And I think the industry's ability to tide them over a period of time has been well documented. So I will not really go and get very concerned about the kind of prices which are there, whether it is oil, whether it is coal, petcoke, all of that. I think, and one point which is there, that there's no point in taking $125 today oil or $300 plus coal and petcoke. Look at it, what the averages are going to be. Look at it where this is going to stop, whether it will take a week, 2 weeks, 3 weeks time. But these wars can't go on. In fact, in 91 we had a much longer Gulf situation, and then also the oil prices dipped to about $5-10. So these are again very speculative plays. Looking at geopolitical risk which is there, the pricing is built in, shipping disruptions are there. So this period of next couple of weeks is a very, very, according to me, abnormal time, and to take an investment decision basis this is a completely misnomer and mistake.
Okay.
So I wouldn't waste much of time and trying to predict. I mean, I think an astrologer will be in a much better position than me to give you any sense on that, and all of us will be either right and wrong, but without any basis.
Okay. Mr. Singhal, good morning. Yes, I mean, that's the point which Raamdeo also shares. In fact, Raamdeo, why don't you ask, Mr. Singhal, what you want to ask?
Yeah. When I said astrologer, I have a huge respect for Raamdeo.
No, obviously that point is...
I'm not taking that slot of astrologer.
None of us,
Anybody can predict it's Raamdeo. So.
No, but Raamdeo...
In fact, I think Anil is the most, experienced cement cement finance guy, and now he's managing a company also, so nobody knows better than him in terms of experience and depth of knowledge. So do you think this is a time to buy? I mean, I'm not saying this is a time to sell, in the sense that these kind of fluctuations for great companies, great businesses, stable cash flow businesses, they give some opportunities, because next 2-3 quarters will definitely be challenged in terms of earnings. And hence markets are short-term. There are a lot of short-term players. They would definitely play on the earnings decline or earnings depression for next 2-3 quarters. And that will throw the bottoms of the stock prices. So do you think the current levels are reflective of the values in the cement companies?
Very much, Raamdeo. I fully agree with you, because stock markets seem to have, and for a variety of reasons they are right on that, when the punished they don't see, there are no emotions left here. So if I have to exit, I have to exit on that. So, but this leaves a huge room for people who want to invest in the future of, say industry, which I know a little better than most industries, is cement. It's not a 1 week, 1 month, or 1 quarter play. It's a play on next 2-3 years time. And largely on 2 accounts on cement I can speak for, is that there are hardly any new capacities. I was hoping that the demand should pick up post monsoon last year, but for some reasons this demand hasn't yet picked up the way it should have picked up. In fact, we should have been almost stock sold situation in March 22, but having caught on the wrong side of it, can't say this. But if you were to look at today the valuations which are there for most of the efficient cement players, okay, according to me, they are very, very fabulous buys today. Wait for a year or 2, and according to me, since we don't have much of capacity creation, demand will catch up, prices will rise up, and cost escalation which we have seen in last a month or 2, or whether it's on account of coal, petcoke and all that, will pitch off. I mean, coal is a dirty fuel which everyone will be talking about, that people should be using less and less of coal, and all of a sudden this has become like the most fancy product. So that perhaps has its own dynamics and own values, but it will come back to the normalcy in next a quarter at most.
Okay, no.
I don't see more than a quarter can remain at such crazy levels.
Sure. Mr. Singhal, I take the point that in the long run, what you're saying, but the business is also done on a day-to-day basis, right? So in that sense, what's your view about the near term in terms of, the demand situation right now, the price hikes, whether that can be absorbed or not?
Well, I don't think anyone today in industry, at least I can speak for cement industry, would be buying coal at $300 plus, and the freight cost would be what it is. So most of us carry inventories. Most of us are savvy enough to understand that things may go out of gear. So always have a fuel security, and particularly energy security for cement industry is a big play. I think the mature players and the large players seem to be hedging against this kind of shocks very well. So I don't think today we should be really worried about what would be today's EBITDA margins. May not be able to pass on if you look at what the cost is today versus what the price is. But on a quarter basis, I think fairly well. I mean, I think this quarter is going to be a little difficult, because demand has been low, prices have been more or less stable to weak, and cost side has increased. So this quarter may be a bad quarter, but as Raamdeo asked this question, whether today's valuations have more than priced it, yes. The answer is very, very clearly yes. I think the markets are far more nervous than the cement industry. Demand is picking up. 22-23, looking at the budget numbers, looking at all other infrastructure play which is going to be there, and the fact that not much of the new capacities. And in industry, oftentimes I have seen the capacities that are being talked about in the cement capacity. I go by the clinker capacity. How much is the clinker, which is the new capacity coming up? Because I may be setting up a grinding station and hoping that somebody will sell the clinker. To me, that's not really the capacity in the industry. So I think today the real capacity of the industry is about 400 million tons. Our demand is about 350, 360. So we are almost at 85, 90%. Now 1 month it may drop below 30 million or 25 million, whatever it is. But that's not going to really making anyone nervous on that. So on the whole, my take is that yes, EBITDA margins are under a little bit of a pressure this quarter. But this quarter is almost at the end of the quarter. Next couple of weeks or a month, I think we'll be seeing sanity returning into the global markets on energy prices, particularly oil and coal. And industry's ability to pass it on during the busy months between now and June should be good enough for us to have good demand and good pricing. Pass it on during the busy months between now and June should be good enough for us to have good demand and good pricing.
Raamdeo?
Yeah.
Any question?
I think he's cut off.
Yeah. No, he can hear you. Any question?
Anil, one question. you're saying that the benchmark should be the clinker capacity rather than the total cement capacity with the grinding and all. So what, just for my guidance and the viewers' guidance, what should be a fair price of a million ton clinker capacity? So if I have 10 million tons of clinker capacity, what should be the fair value? And below that is a kind of margin of safety for me.
You're talking about the new capacity to be set up for the clinkering plant?
No. I have to buy in the marketplace. So if there is an X company which has 10 million tons of clinker capacity and it is available for say $1 billion, say.
Yeah.
So is that $1 billion break even and below that is a good price to buy? And
yes. Less than $100 per ton is a very good buy for per ton of the clinker capacity, because cement has to be taken at $30-40 if it is an extra grinding which is there. But $100 or below that is a very good price. And if the industry has or the cement company has some power capacity, add on about another a few dollars for that. So anything available below $100. Efficient player who has been able to get all the cement stock, whatever they produce, can sell it off in the market. I think it's a huge value creation in next 2 to 3 years time.
And what is the level at which is a no buy? Say $200, $250. What is the level at which is a no buy?
Well, if you cross $200, I think I would be very hesitant to buy it. Having sold Ambuja Cement at $200, which I thought was the peak and continues to remain the peak in my head till date. Is $200 is a price which is fully priced. I would be making much of money. I mean, stock markets can completely prove me wrong. But I would be very hesitant to buy anything above 200, and I would be tempted to buy anything below 100.
Okay, Mr. Singhal, thanks a lot. It's always a pleasure talking to you, and thanks a lot for your wisdom today.
Thank you.
Thanks, Anil.
Thank you.
Let's now from the old economy move to the new economy and talk about the digital space and the IT space. That's something which has seen an up move in a volatile market. C. Vijay Kumar, MD and CEO of HCL Tech, is joining us now. Mr. Vijay Kumar, good morning. Thanks a lot for your patience. Apologies, you had to wait a bit. I'm Anuj, with me is Prashant, and of course we have Raamdeo Agrawal joining us today as guest editor. Mr. Vijay Kumar, first of all, I want to understand the kind of environment that you had and the kind of visibility that you had, say 2 or 3 quarters back. Is that still intact in terms of what's happening around us? Do you have fair degree of certainty about or fair degree of visibility about the business?
Anuj and all of you, good morning, and Mr. Agrawal, good morning.
Very good morning, sir.
In terms of the demand environment, it continues to be very robust. What we saw in the last quarter and what we've been talking about in the industry for the last few quarters, I think that remains robust. All the fundamental drivers for demand continue to be very, very intact at this point.
Yeah. Good morning, sir. One other thing is that what is an operating revenue for us? For a lot of global corporations, it is a capex. The tech spend is a lot of capex with the new models, new operating system, and things like that. So, do you see any kind of hesitation? What order book was? Orders were planned in the pipeline. Do you see any kind of delay in the current environment by the clients, or is it a business as usual for the order intake? And of course, execution is very smooth.
Yes, it is. It continues to be a very robust demand environment, and a lot of tech spend due to the cloud adoption has become more of an operating expense than even a capital expenditure. Customers do not need to invest in a lot of tech systems. They can always consume cloud services. So that fundamentally has changed the expenses from capex to opex. And cloud. There are three broad themes which is driving the big trend. One, of course, is cloud is no longer a technology strategy. It is really essential for the business. It's integral to the business strategy. The second element is modernizing applications and modernizing data to really leverage the power of cloud. And the third element is digital engineering. Still a lot of work. The whole digital engineering space, I would say, is still very nascent, and we see a huge uptrend in the many years, especially with the players who have a very strong engineering and R&D services capability.
Sir, one of the things I was hearing from one of the leaders from the industry is that today in US it is about 2.5% of GDP as the tech spend, and he thinks that in next 1 decade or maybe 8, 10 years, 12 years, it could climb to as high as 5% of the US GDP, which is itself is growing. Do you see that kind of optimistic environment?
Absolutely. I think it's currently it's about 5%. The digital economy or the tech spend is about 5% of the US GDP, and it is expected to go to 10 or 12% in the next 5 years. And that itself is $1 trillion of incremental spend, given the US economy is about $22 trillion. So the 5% increase is close to $1 trillion incremental spend. And this will go into various areas. Not everything is in services. Some of them will be large infrastructure programs. But a significant spend would be in the areas of digitization and digital engineering kind of services, which is where the IT services industry is largely playing into.
Just one, and I'll toss it right back to Raamdeo ji. Mr. Vijay Kumar, Prashant here. I mean, here and now, I mean, markets get excited about tech stocks when there is currency depreciation. Could you tell us how it affects you? Because, I mean, a lot of the exposure would be hedged as well, right, up to a point?
That's true. I think it's actually, we have only seen it for the last 10 days. I don't think throughout the quarter there was different dynamics. And, of course, if the currency depreciation has a positive impact in some areas. It's for every 1% there is probably a 20 basis points kind of an impact. But again, it depends on the basket of currencies, the level of hedging. I would say the impact would be marginal for the current set of changes that we're seeing.
Yeah. So one of the broader questions I would like to ask, do you think this $178-180 billion of exports in the current year, 5 years out, do you think it can be as high as 300-350 billion from India?
Yes, Mr. Agrawal, this is something I mentioned in the NASSCOM Leadership Forum 2 years ago, that definitely, given the buoyancy that we are seeing in the next 5 years, potentially the industry could double. And we are already seeing that kind of momentum across the industry for most of the companies.
Okay, Mr. Vijay Kumar, one concern for IT companies has been employee costs, right? Because a boom in the industry means employees have a lot of options. Good for them, but I know from anecdotal evidence that people take offer and then have a window of 3 months to negotiate on that offer and take a counter offer. And a lot of that is happening in the industry. So, do you think that could be a bit of a sort of a headwind for you or for the industry?
Yes, it's definitely a challenge to retain good talent and continue to upskill them and get better and better quality of work from them. Is an area which all of us are very focused on. But I think the biggest solution is really bringing in net new talent into the industry, whether it is hiring from campuses in India or really spreading the catchment across multiple locations across the globe. And then really accelerating the training program, getting them to do good, productive work. I think that's the only solution. And we see a lot of hope in the fresh talent which are coming into the industry. Their ability to adopt to new technologies is much, much faster than a lot of experienced talent as well. So there is an element of unlearning and relearning in terms of people with 10, 20 years of experience, versus a lot of new graduates who are coming in. They tend to pick up the skills much faster. So there is no relearning. They're really learning all development work on cloud technologies. So I think that's also helping us to bring a lot of fresh talent and get good outcomes.
Mr. Vijay Kumar, thank you very much for that. Appreciate you joining us on this special program and explaining to us how things stand right now. Raamdeo ji, you go back to office and start buying IT, or you've been buying IT?
We are fully loaded. Fully loaded to the entire whatever we can. But there is still disbelievers on the India tech story. See, the best business model is India cost, American value. This Mr. Nair explained us in 93.
Okay.
आप $4 में बनाओ और $24 में बेचो. There is no better business model.
But is arbitrage still there that much?
Huge.
And in terms of valuation, Raamdeo, people may want to believe the story, but what price to pay for that? For example, now 30 times would become a new normal. So is that sustainable for them?
That is individual companies, like smaller companies have more potential for growth and leadership change. That brings, that changes the company's profile altogether. So small, mid-sized company remains mid-sized only. Very unusual. One company might cross the, spectrum and go to the new orbit. So the large companies say you negotiate $1 billion deal or you negotiate a $100 million deal. What's the difference? Sales, marketing, and everything. And I think a $1 billion deal is far more sticky than a smaller deal. Much more longevity. And $2, $3, $4 billion deal, if you do in defense, it makes headlines all over the world. $3 billion deal they announce here in IT, nobody talks about it. And it's a permanent deal forever. It's not one time three. Maybe in 20 years it will be a $20 billion deal. So I think it's the deep competitive advantage of India in IT has to be appreciated. Now, how the markets will appreciate? In 2000 it was 1% of total corporate profit. Today it is 25% of total corporate profits, and very high quality profit. Another thing.
Absolutely, Raamdeo. We appreciate that. In fact, we appreciate your time today and the fact that you came into our office, especially at a time when everything is dug up. So on the roads. So thanks a lot for your time. We'll do one thing. We'll take a break. And of course, thanks a lot for watching this special edition. Up next, of course, Trading Hour comes back.